Hello viewers, welcome back. We are now looking at discrete forecasts. Now as we discussed, there are two parts or two components to a DCF valuation. Number one, we have the discrete forecast, and number two, we have the terminal value. And what we are going to discuss here is something that we have to discuss. So something that we are going to discuss here, it is this item here that is shaded in blue. These items here, these ones that are shaded in blue, they are the ones that we are going to talk about. Whatever you see that is in blue is something that we are going to look at. Whatever is shaded in that blue is something that we are going to focus on as our discrete forecasts, and that's our part one. So whatever you see that is shaded in blue is the discrete forecast, and as you can see, we have a constructed model here with discrete forecasts of 5 years. So we have the discrete forecast period of 5 years, and what that means is that we expect the company's growth to exceed the overall economy for 5 years. In other words, we have to exceed the discrete forecast. They are starting from this point, those 5 years. And we expect that in those 5 years, we expect the company's growth to be exceeding the overall economy. And after 5 years, this point right here, after 5 years, we expect the company's growth to be going at a steady state or in line with the growth of the overall economy. As we can see, forecasting these unlevered free cash flows, forecasting those unlevered free cash flows from year one, forecasting these unlevered free cash flows from year one, from here up to this point. So forecasting from year one to year 5, you can see they are all shaded in blue. But we really want to focus our attention down here to the bottom where we show the present value. We want to focus on this side here where we show the present value of the present value of the discrete forecasts of $50,623. And now the reason as why we are focusing on those is that in order to calculate this present value of $50,623 is based or is computed using the NPV, net present value. In Excel, there is that net present value formula. If you put in that net present value function, it will be able to compute these values right here, and you'll be able to get this value here. Now, the first thing that the NPV function will ask you is the rate, and the rate is actually our discount, the discount rate. And the discount rate, we said from this point that it's going to be our work. This is the discount rate. So this is our discount rate, the work, weighted average cost of capital. And that weighted average cost of capital as our work is 13.5. So the next thing the NPV function asks you is asking for the values. And for the values, we are using the values shaded in green here. These values you are seeing from here, they are the ones in green. So these values that you see here, that are within the green, they are from those functions, as you can see, from those values, or from those tables as you can see them. So these are our discrete values, as you can see. Now, what the NPV function is doing, it is actually helping us, is taking those cash flows, these cash flows here, the cash flow profiles, and it is taking those cash flows and discounting them back at a rate of 13%, 13.5%, that is our work, in order to get the present values. Because you know, from the NPV itself is just getting, it gets a cumulative total, a cumulative value. In other words, the cumulative value is this present value that you are seeing here. If you discount all these values here and you sum their discounted figures, you'll be able to get that figure of around $50,000. Now, the NPV function asked us about the discount rate. It also asked us about the values, but it never asked us anything about the timing. In other words, what do you think is the logic there? Because we didn't, the NPV function never asked us about anything to do with the timing of those cash flows. And we said the timing of the cash flows, the timing of cash flows is really important. It never asked us the timing because it assumes, or that function is making an assumption about the timing, because it was never asking. It never asked us the timing of those cash flows that we've seen. So the implication is that it must be making an assumption for us, which it based on to have those values computed, because there is no way you will not understand when these cash flows are coming in if at all you don't ask for it. So since it doesn't, the NPV function doesn't ask for that, it means it makes an assumption. So we want to look at what was that assumption, or what is the assumption the NPV function makes. So from this diagram here, on your left hand side, sorry, on your right hand side here, you will be seeing the values that we have there. But it will help you understand how the NPV thinks about timing. So when we feed in the first cash flow in here in the NPV function, the first cash flow here as the value, let's say this one. Let's assume this is our first cash flow. So our first cash flow, when you put that cash flow there, so if you feed that first cash flow, the $12,500 into our NPV function, it automatically gets discounted back by 1 year. So it will be discounted back by 1 year. The second cash flow here of 13,900 gets discounted by second year, meaning these are going to be assumed in that perspective, and even these other ones, they will be discounted in that same perspective. So the point here is that these cash flows, the way the NPV function works, it is by default that it takes the first cash flow to be discounted in that same first year, or it is discounted back by 1 year. The 50 cash flow, which gets discounted back by the 50th year. And this is the way the NPV function works. It's by default. So one advantage to the NPV function is that it is relatively simple and faster, because we don't have to enter in any assumption with regards to the timing of the cash flows. But now that's also a disadvantage to that same formula, because the NPV function, we don't have any control over the timing of the cash flows. In other words, we can't control the timing of the cash flow, and at the same time we can't have control over the valuation date. So that's one of the disadvantages. Though it helps you to finish some of these things faster, but it's at a disadvantage, or it's disadvantageous to the model, because we can't have control over the timing of the cash flows and even the valuation date itself. So let's make sure that we understand things from a timing perspective. We need to understand things from a timing perspective, because if you don't understand the timing, then it means you will not be able to have these cash flows. Because if you have the wrong cash flows, you will be able to get wrong results, and that's the problem. Because some of them, they will be using this NPV function and they forget that it doesn't look at the timing of the cash flows, especially when you are using the NPV function in Excel. So I want us to make sure that we understand things from a timing perspective. So if we think that the cash flows in year 1 are actually happening at the end of the year, then the NPV function will discount those back by 1 year, and thus giving us a present value at the end of year 0. In other words, for the cash flow that is coming in year 1, let's say 12, this first one of 12,500 is coming in year 1. So if we are to discount this back using this work here, we shall be getting the present value at year 0. That is the implication, because we are discounting it back. So if we thought that the cash flows in year 1 were happening mid-year or in the middle of the year, because what happens, these cash flows here, we've assumed that they are coming in at the end of the year, and we shall also get the present value end of year 0. But now with the assumption that the cash flows are not coming in at the end of the year, but they are coming in the middle of the year, what happens to that? Because these cash flows, they are not coming in at the beginning and they are not coming in at the end. That would mean the NPV function gives us a present value in the mid of the year, and that is year 0. So understanding the timing of the cash flows is absolutely critical, and for this reason we are going to spend more time on this as we progress through the course. For now, let's move forward and take a look at part 2, which is the terminal value. But I want you to get this clearly. from the timing perspective. Because I'm going to repeat this because I want you to pick me right. From this point here, from that box on our right hand side, we want to make sure that the NPV function we are using, it is actually giving us the right present value as at the timing perspective. In other words, if the cash flows are coming in the middle of the year, let's just use year 2. They are coming in the middle of, let's say, year 2, June, maybe in the month of June. So the thing is, we want to make sure that the NPV we use, or the NPV function we use, because this, for you to get the present value for this, the present value will be the PV, that is the present value, will be in year 1, but it will be in the middle of year, in the mid of year 1. In other words, the NPV we shall use should make sure, the NPV function should make sure that it gives us the NPV for the timing of mid-year 1. If it is at the end, if the cash flows are coming at the end of year 2, if they came in the end of year 2, then we are supposed to get the present value of year 1, meaning it is at the end of year 1. If it is coming at the beginning of the year, we shall get the present value at the beginning of the year, meaning we should take note of the timing perspective of the cash flows. Otherwise, this is what we are going to focus on, to insist on as we go through the model. But for now, let's go to the part 2, which is talking about the terminal values, and we first understand the terminal values. So let's meet in the next video as we are talking about that.